The capital structure is key to understanding the fixed income asset class. Each company has a capital structure and it shows the priority of payments in liquidation. Starting at the top of the structure are the lowest risk investments, and as you move down, the terms and conditions of each of those investments is changing and you are taking on more risk. So that at the bottom of the structure, the equities or the shareholders are the highest risk. Senior secured debt sits at the top of the capital structure. Now this debt is secured over assets of the company. It could be an asset or it could be all the assets of the company. A good example is a property company where the bonds are secured over a building. Term deposits sit under senior secured debt in a bank capital structure. So whilst they're very low risk and there's a government guarantee to $250,000 for term deposits, they actually sit outside a bank's own capital structure and below senior secured debt. Moving down the ladder, we have senior debt. Senior debt is unsecured but very low risk, and typically in Australia is issued for 5-year terms. And if we were looking at a fixed rate bond for a 5-year term with a 6% coupon or interest payment, you would have a half-yearly $3 interest payment for the life of that bond. So it would be known for that period. So moving down the structure, we have subordinated debt. Now you're taking on more risk here, and the risk is an extension to the maturity time. So most banks issue subordinated debt for 10-year final maturity, but it can be repaid after 5 years, and that's called a first call after 5 years. So the risk is an extension of the maturity. The bank will still have to pay you your $100 at maturity, but you should be being rewarded more for that possibility of the extension in maturity time, because the greater the term to maturity, the greater the uncertainty. Okay, hybrids are the last level on the capital structure that is a fixed income investment, but these are really complex investments, and I'd urge any one of you that own hybrids to make sure you understand the risks of these securities, because they're all different, they're unique. It may be that you're giving up a known maturity date, so some maturity dates can be very long, out to 30 or even 60 years, but equally you can also be giving up your interest payment. So with some hybrids, the company can not pay you interest and not ever have to make up that interest at a later date. So in effect, that particular hybrid is much more like an equity in that you don't have a known income or maturity date. So we call those equity-like hybrids. Now the debt-like hybrids have cumulative interest payments. That means that if for some reason they miss that interest payment, they have to be made up at a later date. So there's two additional risks, if you like, you're taking on here, and that's the extension of maturity date, but also the uncertainty in terms of your interest payment. And again, it may be that the maturity the actual investment never matures and you own a perpetual instrument, so you have to sell that to recoup your capital. At the bottom of the capital structure is equity or shares. If you own shares in a company, you're in the highest risk position. So if a company went into wind-up or receivership, the accountants would come in and start selling down the assets. Now the proceeds of the asset sales would be from the top down, but the losses are taken from the bottom up. So as a shareholder, you're in what's known as the first loss position, and you're in the highest risk position in the capital structure. So you would need to be rewarded the highest level of those investments throughout the capital structure. In conclusion, the capital structure is really important to understanding the fixed income asset class. If you have confidence in the issuer issuing the bonds, you can start to look down the capital structure for higher returns. Equally, if you're a bond investor or fixed income investor, you have that certainty of interest and principal when it comes due. So what you're actually analysing in a company is its ability to survive. That is, what assets does it have to sell if it gets into trouble? Can it tap debt markets? A number of other factors. Quite different to a share investor, because if you're a share investor, you're analysing whether the company will grow. So quite different dynamics and of course quite different returns and risk profiles.